What is going on, investors? Hopefully, guys are doing well out there. Time to keep earnings season moving right along. We're going to look at SoFi Technologies, ticker symbol SoFi. Year-to-date, shares of SoFi are down 28%, but over the last year have done relatively well, up 38%. That includes a 9%, nearly 10% drop after the company reported their Q1 earnings before the bell today. We'll get into the financials. As you recall, this company gives personal loans, student loans, and home loans. And the mix has changed over the years. They used to be primarily student loans. Now they're more personal loans. Home loans happens to be the fastest growing business of this company. They've also changed their business model. They used to just originate loans and then collect fees on that. Now they're like your traditional savings and loan bank, very similar to a Bank of America or JP Morgan. They make money the same way. They take on deposits and then they loan that money out at a higher interest rate. And certainly with interest rates higher, you're getting some very, very nice earned income on that interest. Now, we look at this from a technical perspective as well. I've traded this stock in the past, actually successfully. So I'm interested to come over here and look at the technical pattern, because if you understand the technical pattern, whether you want to go long fundamentally this one or not, there's certainly some opportunities to trade this stock and make some decent money. Now, like we said, over the last year has done relatively well, certainly from the banking sector has done well over that time. Certainly not like NVIDIA-like return, but certainly solid enough returns year to date, though. You are getting hammered at SoFi. Now, those Q1 revenues came in at $580 million and some change. That was really solid, 26% growth year over year. They beat expectations by about $21 million, but they also beat on the bottom line results, which we'll get over here and we'll show you from the financials. This company's doing a nice job actually earning some profit this time around as they've scaled up that kind of deposit and loan business. But what came in soft was that Q2 guidance. You had adjusted revenue coming in the next quarter at $555 million up to maybe $565. The problem is Wall Street was expecting a number closer to $590 million. So even on the high end estimate at $565, even if you assume this company is going to sandbag a little bit and they beat expectations by about $21 million, even if you give them credit for a big beat, they're well underneath a $590 million estimate. Also, the high-end estimate for the upcoming quarter at $565 is underneath the low-end estimate. So this company came well underneath analyst expectations in terms of revenue. $575 was the low end. So they're going to likely fall below 20% growth rate on that revenue side. Now, what was interesting, though, is the company more or less reaffirmed their full year 2024 GAAP EPS coming between 8 and 9 cents. The consensus was 7 cents. Their previous guidance was between 7 and 8 cents. So they basically bumped it up a penny on either side. Also, adjusted EBITDA, $590 million up to $600 million. The consensus was $585. So it looks like to me, this company is going to likely have lower revenue, maybe even for the rest of the year, because this lower Q2 guidance of 555 to 565, it brings into question Q3. Can we really do $612 million? Q4, are we really going to do $622 million? But this company, maybe through cost cuts, maybe through the higher interest rates, earning the company more money on the loan products, it looks like they're still guiding for similar types of profits. And that is where the disconnect on Wall Street is going to appear. There's going to be some investors that are going to believe it, and there's going to be others that don't. Now, when we come over here and look at the loan mix, it's changed over the years. It used to be a big student loan product. That shifted a little bit, still a very big business. And in fact, it was up 43% year over year. But look at your personal loans. Out of your $4.37 billion of total loans, nearly $3.3 billion of those are personal loans. And so those tend to carry higher interest rates. You tend to have a little bit higher interest rate on the personal loan. So you're able to take on deposits, as we see here. Those grew very nicely year over year. You're able to take on these deposits at maybe a quote high checking account interest rate, 4 or 5%. SoFi is one of the higher payers on deposits. And then you're able to turn around and do a personal loan at a much higher interest rate. However, you have to remember, these personal loans carry obviously more risk. There's no collateral like a car or a home. And if the economy turns sour, the unemployment rate starts to tick up, you will see deterioration in the personal loans. Now, the company has not seen that over the last year, because here's your provision for credit losses. This is money that SoFi is setting aside just in case people don't pay. Well, last year it was 8.4. Now it's 7.2. So they're actually seeing an improvement year over year, at least on their provision for the credit losses. And so despite the higher personal loan volume, they're not setting aside more money. Now, could that be something that goes bad in future quarters? It certainly could, but right now the company's not projecting that. Now, on the home loan side, massive growth here, 274%, not quite the second leading origination volume, but approaching there with home loans. Obviously, don't come typically with the interest rate that you see on the personal loan, but you are collateralized against that real estate property. Now, your total interest income went from 371 all the way up to nearly 666. Your interest expenses, obviously most of that comes on deposit, but this is a very high margin business. Off of 665 in revenue, non-interest income coming in at 402. That gives the company other revenue sources like their non-interest income. They're still originating loans and selling them, but way down year over year. You're still servicing some loans, but the fees there are down. Your technology and products relatively flat. You do have some other revenue here. It'd be interesting to see why that went from 27 all the way up to 92. So your total net revenue coming in at close to 645. Now you do have other expenses. You have your technology and development expenses. Those went up a little bit year over year. Again, we have to factor in this company had 26% growth on that revenue side year over year. You're expecting these expenses to continue to rise. But what I noticed was, look at your sales and marketing expense. It actually went down from 175 down to 167. That's a good sign. Cost of operations ticked up a little bit. Your general administrative ticked up. And again, we talked about those provision for credit losses. Those remained relatively stable. So you take your 644 in revenue minus off 550, and here we go. Net income coming in at $88 million. There was a loss last year. So this company's turned positive from a net income perspective. You have to factor in, this is still, despite it's being a $7 stock, they've got a huge amount of float out there. $8.3 billion valuation on a bank that's just marginally profitable in an environment where you have low unemployment. So you have good servicing on the loans. Any downturn, there's always going to be those bear case out there with SoFi that you have a downturn in the economy. And this is the first banking stock that would just get absolutely destroyed because of their loan mix. We talked about most of it absorbing in personal loans, and those people tend to not pay when they lose their jobs. So as long as people keep their jobs, this company is actually relatively well positioned. From a technical perspective, micro trend, it's not good. We made a high, a lower high, lower high. We basically confirmed another lower high. However, there is a bed of support at this stock. Seems like people step in this $6 to $7 range if I were to take a shot at this one, whether it's for a long-term position or whether it's a shorter-term trade. I think the setup's pretty easy. You've got a bed of support. I'd like to have a stop loss right underneath that, maybe right about $6.30. So I'm playing 70 cents to the downside as my max risk on SoFi. This one is not set up perfectly to where I want to run out to my Schwab account and put the trade on, because again, you're making lower high, lower high. You have to actually assume that trend is going to continue. So your upside is really a break of trend. And can you have a break of trend? Absolutely. And if you do, this one's probably heading back into the $7, $8, $9 range. So you can have 70 cents of downside with $2 in upside, but the trend is simply not telling you at this point. That's at least in the shorter term. If you do zoom this one out, it paints, with SoFi, you're getting kind of two different stories. You had a low here, higher low, and maybe we're about to confirm another higher low. You have a conversion of two different areas of support. So if SoFi were to turn around, it'd actually probably be right about here. This one is telling conflicting stories, but I think if you have the unemployment rate stay where it's at, and if you believe Jerome Powell, where he's going to, quote, stay higher for longer, it's going to benefit this company. And these financials are good enough. I think just the question is, can they deliver on the profit side? Because now we know the next several quarters are going to have to be revised down from a revenue perspective. And this company just doesn't have the track record like a Jamie Dimon over at JP Morgan or like Bank of America. It's going to have to prove itself to investors. And today, investors are not believing what SoFi is saying. We'll be back later this week with more. Thanks for tuning in today.